Hello, how are you doing? My name is Roger Gitonga, an audit and assurance expert tutor, and I shall be taking you through this interesting topic known as subsequent event. I want us to delve into the significance of this chapter, an area that some students tend to neglect, yet it tends to be one of great significance. So we will take some time to thoroughly understand the importance of this area, how it can be tested, and probably additional tips that you can borrow for this particular area. Allow us to start. Now, as you can see here, first and foremost, I'd want to bring to your attention that subsequent events is primarily found at the study hub under chapter 29 under the section 4. All right, so 29.4, you will normally see the topic subsequent events ISA 560. So kindly go to your study hub and read a bit more about it. Secondly, you should also spend some time doing the quizzes after you're done with that chapter. They're thoroughly about 5 questions that are there to enhance your understanding of this area. And then you can delve a bit deeper into the concept of practice. Now, practice is where you want to thoroughly revise and understand better about this area. Let's delve into some few facts. One, subsequent events are considered to be a key examinable area. So it's not an area that you want to particularly neglect. It has its great significance and you have to be particularly careful about it. Secondly, you want to understand the types of audit evidence that the auditor should obtain to confirm that the accounting and disclosure requirements have been applied correctly within the financial statements. So we're going to really appreciate the difference in the concept of accounting, which is normally covered under IAS 10, which deals with the events after the reporting period. And we will also be looking at ISA 560, which focuses on the subsequent events and the auditor's responsibility tied to the same. Please note that this is tested in both section A and B, and therefore it's not an area that you can particularly rote learn because it can be tested in any way whatsoever. And therefore you have to be particularly careful about it. Now let's delve into a few things here. What is ISA 10, or rather IAS 10, sorry. What is IAS 10? It shouldn't be the first time that you've seen it, because the reality is you probably have seen it before in financial accounting. But allow me to take you quickly through it and maybe just delve a bit of a better understanding around what it is. So what is a IAS 10, sorry, normally states is that it outlines how to handle events that occur between the end of the reporting period and the date when the financial statements are authorized for issue. Allow me to give an example here. I want us to look at this timeline particularly. Now, if you look at it very carefully, we have the end of the reporting period for this company, which is the December of 31st, 2023. And within the accounting department, they are still closing that the books of the accounts for that year, and we can see that this is being done or has been done by January 31st. So we know that there are certain events that could still occur even after the end of the reporting period. Then we look at the authorization by the board of directors, which is on the February the 15th, and we therefore also see the approval by the shareholders, all right, which is the February of the 28th. Now we do appreciate the fact that the financial statements will be considered authorized for issue on February 15th when the board of directors authorizes them, and that is really just between this period, the events that could occur between that period. We have to be very keen before it is actually authorized and issued. Now, I want us to look at the adjusting events. Again, this is just a quick run through of what you probably should have done in FA, but I do think it's important for us to significantly understand what it means. Now, adjusting events would normally occur if they provide evidence of conditions that already existed at the end of the reporting period. Now, what does this necessarily mean if we were to think about it carefully? Let's look at an example. First and foremost, we have a settlement of a court case. And you see, this settlement of a court case is considered to be an adjusting event because it provided additional evidence pertaining a certain liability that existed before the reporting period. It's as if we now thoroughly understand what actually transpired as a result of that liability because of this decision made in that court case. So we know how to deal with that transaction better. Secondly, there could be the receipt of information indicating that an asset was impaired at the reporting period. So we know that the asset was there at the reporting date, but we've now received additional information that gives us evidence of conditions that of that asset, that this asset actually became impaired. So we now get a better understanding of what happened, pertaining this asset from these events that occurred after, and we therefore need to adjust. Now, what does that necessarily look like? You will see. While non-adjusting events are basically events that are indicative of conditions that arose after the reporting period. Now we have to be very keen that these events do not necessarily give us additional evidence of conditions that were existing before. And therefore, we don't adjust them within our financial statements. Let's look at an example. One, a major business combination or disposal. So we've either merged with another business, and you see this, there's no providence of additional information that this was to occur before the reporting period. This is basically something new that happened after the year had ended, and therefore we do not have to adjust for such. Secondly, you make an announcement that you plan to discontinue an operation. Again, this was not necessarily providing evidence of things that might have been pertained or present before the year end. Or thirdly, significant changes in asset prices or foreign exchange rates after the reporting period. Again, we do appreciate the fact that this could ideally have occurred after the reporting period, as we can see here, and they do not necessarily provide additional evidence pertaining what was existing before, because we appreciate the fact that this could have been changed due to market fluctuations that happened after the year end, and these are not predictive before the year end. These are not giving us additional information before the year end. How do we treat therefore? Well, for adjusting events, we simply adjust. We make the correct adjustment in the financial statement. So if a provision, for instance, due to a court case is required, we will actually create or increase that provision, within our financial statements. And that's what we mean by adjustment. But with non-adjusting events, if material, we'll disclose them within the notes. Now, allow us to delve into ISA 560. These definitions are found within their standards themselves. Now, I want us to first and foremost make it clear that auditing considerations cover a longer period than the accounting definition. So what we consider as events after the reporting period under ISA 560 is actually a longer period than what would normally look at under IAS 10 within the accounting framework. Because if you look at the definition here, this says that these are events that occur between the date of the financial statements, which is what we also have for the events after the reporting period, but we see here that it is also till the date of the auditor's report and facts that become known after the date of the auditor's report. So we do appreciate the fact that this is way longer. This is literally even after we've issued out the report. What is our objective as an auditor? Well, the first objective is to really obtain sufficient appropriate audit evidence that all events occurring between the date of the financial statements and the date of the auditor's report have been either appropriately adjusted or disclosed. So our focus primarily is from the first objective concerns events after the reporting period from an accounting perspective. We want to see whether you've done the right treatment, okay, between the date of the financial statements and the date of the auditor's report. Have you appropriately adjusted for maybe any adjusting events, which we've already seen in terms of definition? Have you already disclosed non-adjusting events? So we have to collect sufficient evidence and appropriate evidence surrounding those events to try and see if the accounting treatment has been done correctly. But our second objective thoroughly is to respond appropriately to facts that become known only after the date of the auditor's report. Now, if you look at this carefully, the first one was the collection of evidence, but the second objective is the response to the same. Okay, and this second objective concerns our responsibility as the auditor after the audit report has been signed. So what should we do if, for instance, any facts come to our knowledge that could easily have impacted our auditor's report? What should we do? And yet the auditor's report has already transpired, it's already passed. So what do we do? How should we respond to the same? What legal advice should we sought for? So what is our next course of action in such cases? How do we prevent reliance on the same? Now, before the auditors report thoroughly, the auditor's responsibility regarding events occurring between the date of the financial statements and the date of the auditor's report is often described as an active responsibility. And the reason is because the auditor's overall responsibility is not discharged until the auditor's report is signed and dated. Now, this basically means that because these events occurred before we signed the report, we still have an active responsibility to ensure we collect sufficient and appropriate evidence pertaining this area. So some of the procedures we could even apply here is to probably review and understand the management's procedures for identifying subsequent events, or even reading the minutes of shareholders or even board of directors held after the reporting period. We might even try to read the latest available interim financial statements or budgets or cash flow forecasts or management reports. We can even inquire from lawyers considering any court cases or any litigation or any claims that might have been made against the client. But we also have events after the reporting date but before it has been issued. So what happens in such case? The auditor has no active responsibility to make inquiries or even perform further audit procedures to discover any subsequent events after our auditor's report has been issued. Therefore, our responsibility here is very passive, where we only react when we have become aware of certain relevant matters. Then after the financial statements have been issued, the auditor has no obligation to make any inquiry. However, if the auditor becomes aware of a fact that existed at the date of the auditor's report, and which, if they knew at that date, might have actually caused the opinion to be changed or to be modified, then the auditor might want to do a few things. One, either probably consider whether the financial statements need some revision and also discuss these matters with the management and those charged with governance, and sometimes maybe take appropriate action and seek for legal advice. Okay. Now, some jurisdictions could allow you to withdraw the financial statements while others might not. And in such, the auditor should be aware of what to do. Let's look at this question very quickly. This is from your Study Hub Oil Records. As you can see here, you are an auditor. There are certain events that have been brought there. The question ideally asks us that for each of those following three dates, the 15th of February, the 1st of May, the 30th of May, it wants us to state whether the events occurring on those dates are adjusting or non-adjusting, and you should give reasons for your decision. And secondly, explain the auditor's responsibility, one, and the auditor's procedures that should be carried out. And you're told here your answer should assume that the directors agreed to make any necessary changes. So let's look at 15th of February. First of all, you're the auditor of Oil Rakers Company. They extract, they refine, they sell oil. The following events occurred after the year ended 31st of December. Let's look at 15th of February. What happened? So the scenario shows here that on 15th of February, there was a bankruptcy of a major customer representing 11% of the trade receivables on the statement. My goodness. So one of the major customers who was there before the year has actually become bankrupt. So already you can see they were there before the year, they existed, but this has actually, we've gotten additional evidence. So what do you think we should do in such a case? Think about it. Pause here. What's your answer? Well, drum rolls. Adjust. Why is that the case? Well, you do realize there's additional evidence that is provided. I mean, the bankruptcy of a major customer will normally provide additional evidence. The customer will not be able to pay their debts due, and therefore receivables are overstated, and the bad debt allowance is understated. So therefore, an adjustment for the amount of the receivable should be made in the financial statements if it is material. Then we come here. What is the auditor's responsibilities? Well, they should identify material events. What does that mean? Well, you realize the bankruptcy of the major customer takes place after the reporting date, but before the financial statements and the auditor's report are signed. And therefore, since the report has not yet been signed, the auditor is still responsible for identifying material events. I mean, they have an active responsibility, which means that audit procedures should be carried out. Okay, so what are some of these procedures? Allow me to expound on them. One, the auditor should request maybe a formal letter from either receiver, liquidator, or an administrator handling the bankruptcy. This letter should confirm the status of the customer and the likelihood of any payments being made. This step ensures that the auditor has documented proof from an authoritative source about the customer's inability to pay. See, this collects more evidence. Secondly, the auditor should review the invoices issued to the customer before the year end. This involves maybe matching the amounts on the invoices to the amounts recorded in the accounts receivable ledger. Now, this step ensures that the recorded receivables are accurate and correspond to actual sales made before the reporting date. Or three, the auditor should verify that the receivable balance has actually been reduced by the amount due from the bankrupt customer. Why? Additionally, the auditor should verify that this amount has also been recorded, probably as a bad debt expense, in the profit or loss account. This adjustment ensures that the financial statements do not overstate receivables and accurately reflect the loss incurred due to the bad debt. All right, so I've even explained why we should do this, and it therefore shows we meant to have an active responsibility. You understand? So we were collecting more evidence pertaining these conditions, pertaining these events, and this comes from an accounting perspective. Have you done the right thing? All right. Now, what about the next questions? Well, let me do this. You go, champion. You go finish the question on the study hub. I've done one. I've showed you how to do it. It's me to pass you the chalk. Continue doing this question. All right. Practice it. I've started. I've rolled the ball game for you. Go and finish it off. All right. Now, as we come to the near end, there are some certain things I want you to go and read that can be very helpful. And those are your examiner's reports. The first one I want you to go and read is the Audit and Assurance March to June 2023 Examiner's Report. You will see there two questions, or rather a question that was tested on subsequent events, and you can also get the chance to enter the mind of the examiner pertaining this area. All right, so I wanted you to engage with it. Kindly go download it. It's there on your sccaglobal.com site. Look for it, download it, and once you find it, go for the next one. March and June 2024. A year later, you will also see this. It's interesting that they're both March to June. All right, I'm not saying that subsequent events only come at that time, but it's quite an interesting trend. All right, anyway, I really hope you enjoyed this video. Thank you so much for watching. Have a lovely revision session and a reading session as you go through the other areas. Goodbye.